Well, let's talk a little bit more about today's broader market action, what we could expect going forward. And for that, I want to bring in Octavio Marenzi. He's Opimas CEO. And Octavio, it's great to have you. Just in terms of, let's just get your thoughts, I guess, on the biggest drivers in the market, because I think that's a big question at this point. I was going through your notes. You were pretty optimistic. You mentioned the Fed, you mentioned the election, you mentioned those M&A deals that we got yesterday. But at this point, what do you think is the biggest driver of the market over the next couple of weeks?
Well, I'm really glad you saw some optimism in my notes, because I didn't feel terribly optimistic writing there. So you must have been reading between different lines than I was. I think the major driving thing in this market is the Fed, and the Fed, those three things. They pumped so much money into this market that we've seen an unbelievable recovery since the middle of March, an unbelievable rally in the stocks, and particularly in tech stocks. And really, it is the Fed's monetary policy that is driving tech stocks and that is behind this rally. And what we saw over the course of the past couple of weeks was sort of hit a bit of a local peak around the 2nd of September, 3rd of September, when the unemployment figures came in better than we expected. So it looked like the economy was starting to recover, unemployment was going down, there were fewer initial claims for unemployment, and that sort of spooked the market, because they're sort of thinking, well, if that's the case, then the Fed has less rationale to maintain the monetary policy that they have in place. So that is scaring people a bit, and they're going to be watching the FOMC, the Fed Open Market Committee, and what they have to say now. And I really expect to hear them say nothing at all, and basically try and placate the markets and reassure them that there's going to be no change, and they're not even thinking about changing monetary policy at this stage. Because if they do let that out of the bag, that they think about changing at some stage in the future, it's going to spook the markets, and people are going to dump tech stocks, and we're going to see a major correction. So that's basically what we're looking at there.
Well, Octavio, I guess maybe optimistic might have been too strong of a word, but we've been talking to some market guests recently who've been calling for a bigger pullback ahead. So the fact that you didn't explicitly say that, I guess, made me think that maybe you were a little bit more optimistic than you are on the markets. But when you talk about how to play this right now, I mean, that's a big question going forward, whether or not we should bet on some of those beaten down sectors, whether or not this rotation that we've seen over the last couple of days, if that's going to stick. Where do you stand on that argument?
Well, I think in terms of the tech stocks, I would be very cautious about them. I think we're in for a big correction there at some stage. In the short term, I think we're going to see things keep going up. So I can't tell you exactly when that correction is going to come, but it looks like these stocks are wildly overvalued, and I really don't like them. If you look at the financials that you were talking about just before as well, I'm a bit more optimistic there. A lot of the financials took very, very hard hits against their balance sheets early on in this crisis, saying we're going to see a lot of loan defaults, and they've set aside a lot of capital to deal with those. And I think they probably overestimated. And eventually what we're going to see is the banks, the retail and wholesale banks, walk those things back and say, we overestimated what the credit losses were going to be. They weren't as bad as we thought. And that's now going to impact our balance sheets positively and flow into earnings. So I'm a bit more optimistic than that. It is, of course, very difficult for the financials to make money and navigate a zero interest rate environment. They're very dependent on their net interest margin, and at these low levels, that has really been hit, and there's going to be ongoing pressure there. But the big disaster that we thought was going to come in terms of defaults on loans does not seem to materialize. So those forecasts that were made back then seem to have been overblown, and I expect the financials to actually benefit from that in the coming quarter as they wind some of those provisions back and undo those.
Octavio, I want to get your thoughts on the recent Bank of America fund manager survey that we got, because in that they asked the fund managers whether or not they think that we are in this bull market, and 58% of investors saying that we are in a bull market, that a new bull market has begun, up from 25% in May. Where do you stand, or what are your thoughts just on that narrative, just in terms of what you need to see, I guess, in order to be convinced that we are in this new bull market?
Well, I don't know what the survey said. That when were they counting from? When do they think the newest bull market started?
Well, that's a good question. I don't know the exact answer to that, but just in terms of, I guess, what do you need to see just for, I guess, to have a little bit more conviction then in terms of where the market is going, that we are in this bull market and that these gains are here to stay?
Well, like I said, the Fed is really the driving factor in this. So this ultra loose liquidity that has flooded the market is what's keeping things up. As long as that keeps going, we're going to be fine. Or the market, I shouldn't say will be fine. The market will be fine. At least will be maintained at high levels. Now, you might argue that's a bad thing for the economy overall, that creates some sort of distortions in the markets. And I'd be open to that argument, but it's going to help the market stay really high. So as long as the Fed is looking at the economy and saying, well, things look really bad, we need to maintain the economy, we need to support it, stocks are going to do really well, tech stocks are going to do even better. As soon as they start to think, well, now things look a bit better and unemployment looks much better, we can start to undo some of this monetary policy, we're going to see a correction. But I think they've been quite clear on that. Jerome Powell has been absolutely clear that they're going to continue these ultra-low interest rates for at least 18 to 24 months. So I think we're pretty safe on that front. And if we do see a bit of a correction in the markets, I would expect the Fed to step back even more aggressively and reinflate that and keep things up. So I think we've sort of got a really nice organization with the Fed now, where they basically put a put option in the market and is not going to let it go down. And they're not really going to let it go down during this election campaign, and they're just going to maintain their policies as best they can for the foreseeable future. So I think as long as that keeps going, we're fine. Once they start to tighten monetary policies, we're in for a rough ride. But that could be quite some time down the road.
All right, Octavio Marenzi, thanks so much for joining us today.